$250,000 puts 2 crews on the road in commercial asbestos removal. That is the top of the trade's own advertised range. The bottom is $75,000. Nobody audits either number, or any other price this trade advertises, so hold them as a bracket and take the top of it anyway. It still gets you in. Which is strange, because there is a rule almost everybody carries about work like this, and it is a reasonable one. Hazardous work has a wall around it. Suits, respirators, a federal exposure limit of 1/10 of a fiber per cubic centimeter of air, a trade nobody just walks into. Michigan State University's 2026 pre-qualification form for asbestos abatement contractors quietly disagrees. Question 8 asks a bidder to list the abatement equipment it owns, and then, in the same breath, everything it normally rents instead. The institution writing the checks treats renting as ordinary practice, because it is. A mobile decontamination trailer hires for $600 to $1,500 a month. A sealed filter vacuum starts at $50 a day. And the accreditation is a course measured in days. Whatever sorts this trade into a handful of large companies and a very long tail of small ones is sitting 22 questions further down that same form, and it has nothing to do with what you own. Every dollar in this trade is released by a document. The work becomes compulsory before anybody wants it. Most of those documents come out of the Federal Asbestos Air Rule the Environmental Protection Agency administers. Before a demolition or renovation, the rule requires a thorough inspection of the part of the building being touched, then notice to the regulator, before any demolition at all, whatever the amount, and before any renovation disturbing more than 260 linear feet, 160 square feet, or 35 cubic feet of regulated material. Below those numbers on a renovation, nothing has to come out. Above them, the paperwork starts first. The rest arrives unscheduled, when a plumbing crew with no accreditation opens a ceiling and hits pipe insulation. That paperwork is what you would be selling. Your customer is buying a licensed, heavily insured company whose name goes on the waste shipment record and the air clearance certificate, so the name there is somebody else's. And the record has teeth pointed at that customer. Under the federal waste rule, if a signed copy has not come back 35 days after the load left, the generator has to chase the transporter and the landfill. At 45 days, it has to report the missing paperwork to the agency in writing and explain, in a signed letter, what it did to find the load. That duty gets described as the landfills. It is the generators, and the asymmetry is your demand curve. Everything priced from here to the end of the cost base comes from the trade's own published ranges, quoted by suppliers and contractors. Nobody audits them. The regulatory figures are exact. A negative air machine, the box that holds a sealed work area at lower pressure than the corridor outside, runs $1,200 to $4,500, and up to $6,800 for the large stainless units rated at 2,000 cubic feet a minute. How many you need is decided in the Federal Construction Standard for Asbestos, which lists 6 permitted ways to control the highest hazard class of the work. Choose the sealed negative pressure enclosure, and 2 specifications become mandatory. At least 4 complete air changes an hour inside it, and the enclosure held 0.02 of an inch of water column below the pressure around it, so every leak pulls inward. Run that against a 10,000 square foot work area. 4 air changes an hour is 667 cubic feet a minute for every foot of ceiling height. 9 feet wants 6,000, 12 feet 8,000, 16 feet 10,667. Divide by the machine's rating and round up, because nobody runs a third of a machine. On the 2,000 a minute units, 3, 4, 6. Ceiling height and the invoice decide which of those 3 numbers you buy. The decontamination area sits in the same standard. On a job disturbing more than 25 linear or 10 square feet of pipe insulation or sprayed-on surfacing, you build 1. An equipment room, a shower, and a clean room in series, every worker passing through. $15,000 to $50,000 to buy a towable multi-stall version, or $600 to $1,500 a month on hire. That doubling runs down the list. Sealed filter vacuums at $1,000 to $3,500, or $50 to $150 a day. Sampling pumps at $500 to $1,500. Bought outright, a 2-crew startup runs from $75,000 to $250,000, much of which never becomes steel. Bonding deposits, licensing, insurance. But almost every line has a rental price beside it, which turns the capital number into a decision about your cash flow. And the customer already knows. It is what question 8 is for. A scored institutional bidder list assumes, in writing, that a serious contractor rents. A disposable coverall costs $10 to $15, and a worker gets through 3 to 5 in an 8-hour shift. The decontamination protocol is why. Every exit from the sealed area, each break and the end of the shift, is a strip and a discard inside the dirty room, and the suit does not go back on. A 10-man crew at 4 apiece is 40 suits a day, $400 to $600 daily, $2,000 to $3,000 a week, in clothing that ends up in a bag. The costs with no rental option are the ones that burn, and that is most of them. Filter cartridges, $15 to $30 a pair, changed daily. Powered full-face respirators, $800 to $1,800 a blower set. Polyethylene sheeting, 6 mil thick, 6/1000 of an inch, at $120 to $200 a roll, covering 2,000 square feet, doubled on the floor and doubled again on the walls. Disposal bags at $1.50 to $3 each, doubled too, because bagged waste travels double-bagged. Then the people who check the work and do not work for you. A certified industrial hygienist bills $1,000 to $2,000 a day and up. Bulk samples beforehand, $20 to $40 each. Air samples during the job, $25 to $50. Electron microscopy at clearance, $150 to $300. Your containment stands until an outside party signs that it can come down, and the waste leaves on a meter. Non-friable material, the kind that will not crumble to powder under hand pressure, tips at $50 to $165 a ton, and a sealed roll-off swap is $500 to $1,500. Certified haulers charge $4 to $8 a loaded mile, which quietly draws a circle on a map. Past a certain distance from a landfill that takes the material, a job stops being worth bidding. Almost every figure there moves with the work. No large, fixed monthly nut. No quiet month where an idle machine eats the owner alive. That cuts both ways. Very hard to lose money slowly here, and just as hard to earn much from scale on the cost line, which matters later. Pricing stops behaving like labor only at the smallest jobs, where a mobilization minimum of $2,500 to $5,000 is charged before a square foot is touched. Against the trade's rate for floor tile and the adhesive under it, $5 to $15 a square foot, that buys roughly 170 to 1,000 square feet of removal, and 160 square feet, the federal line above which the material must come out on a renovation, sits just under that band. At the smallest regulated renovation in the country, the customer is mostly paying for the trailer to arrive. Then there is the change order, where a survey missed the adhesive under a second layer of flooring, the containment is already standing, and no competing bidder is on the property. Nobody publishes the margin on those, so there is no number here for it. Back to that form, and 22 questions further down. Michigan State released its 2026 pre-qualification application on September 26, 2025, took submissions until November 14th, and the approval it grants runs to the end of December 2026. Question 27 asks for 3 years of total recordable incident rates, with the federal injury logs attached. Question 28 asks for 3 years of experience modification rates, documented. Question 30 asks for current bonding capacity, with a letter from the surety agent. Then a 5-year violation history and a certificate of insurance carrying pollution coverage. Responses, the form says, will be reviewed, verified, and scored. Read those together and they share one property. None of them can be bought this week. Bonding capacity is written by a surety underwriter off audited accounts and a clean compliance history, and it sets the largest single contract you may sign and the largest total book of work you may carry at once. Sureties do not publish their formula. Public agencies running the same arithmetic do. Oklahoma's Transportation Department makes a bidder file an audited financial statement carrying an accountant's opinion, then writes the consequence in one sentence. The prospective bidder will not be qualified for more than 2.5 times its current working capital as computed by the department. This year's revenue ceiling was fixed by last year's balance sheet, by somebody who cannot be paid to move it. The experience modification rate runs the same idea through the payroll. Asbestos abatement has its own workers' compensation class code, priced by California's Rating Bureau at an advisory pure premium of $10.33 per $100 of payroll, effective September 2025. That is only the projected cost of claims, before the carrier's expenses and profit, and before the modification rate multiplies it. On a $1 million payroll, the starting point alone is over $100,000 a year, and the modifier is built from your last 3 years of claims. One exposure claim therefore does 2 jobs. It raises the price of every labor hour for years, and it lands in a file your customer reads before deciding whether you may quote. That form settles a second thing, and it decides what one of these companies is worth. The premium end of this industry gets described as running on recurring revenue, long-term agreements with hospital systems, universities, utilities. This document says otherwise. Approval covers 1 calendar year, contractors reapply every September, and 3 clean years earns a shortened application, never committed work. In the university's own words, successful pre-qualification does not specifically guarantee work with Michigan State. What the top of this trade holds, then, is standing, a scored, annually re-earned place on the list of companies permitted to bid, good for 1 calendar year at a time. Buy one of these businesses, and that is the asset on the other side of the wire. You would also be buying something on no equipment list. Pleural mesothelioma has a documented latency of 10 to 57 years, 30 to 40 typically, on the Federal Toxic Substances Agency's own clinical material. A failure here cannot be observed inside anybody's ownership period. You buy decades of other people's finished jobs along with the trucks. The enforcement numbers are smaller than people assume. In March 2024, the Environmental Protection Agency's New England office settled Clean Air Act asbestos violations with 2 Rhode Island companies for $24,800. That is the administrative track, which on the schedule in force since January 2025 can run to $59,114 a day. It rarely does. What does the damage is the record, because the record is what the surety and the customer read next year. Engineering News Record ranks the 20 largest abatement contractors that report to it every year. On the 2022 revenue year, the largest booked $191.4 million of abatement work. Number 20 booked $13.4 million. All 20 together came to just over $1.2 billion. And the whole abatement specialty is 0.7% of the entire top 600 specialty contractor list. There is no giant here, just a long tail with a few tall stalks growing out of it. That is a description of a shopping list, and several people have read it as one. 2 of them started buying before there was anything to combine. Earth Services and Abatement, founded in Sioux City, Iowa in 1982, took a firm in Des Moines in 2015 and a demolition company there in 2017. One Priority Environmental Services out of Fort Worth took A1 Abatement in Gatesville, Texas in 2016 and West Texas Abatement in Lubbock in 2017. Then, in February 2019, backed by a private equity firm called O2 Investment Partners, the 2 merged. Read that announcement and the whole thesis of this episode is sitting in one sentence. It records one partner's experience modification rate at 0.77 and gives the combined business aggregate insurance coverage and bonding capacity of $10 million and $60 million. Those are the 2 numbers question 28 and question 30 ask for, published on day 1 as part of the case for the deal. 8 months later, they added Snyder Environmental of North Little Rock, took the name EIS Holdings, and reported 550 employees across 19 offices. Then it kept going. Simpson Environmental in Trilby, Florida. Potomac Abatement in Jessup, Maryland. AET Group in Albany, Georgia, which arrived with 7 locations of its own. 14 named acquisitions run down the company's published timeline, from 2015 to this year, most of them firms nobody outside their county had heard of. On July 20th, 2021, O2 sold EIS to an affiliate of Sun Capital Partners. 21 months after the name existed, the company had more than 750 employees, 24 offices, and over 1,400 customers. The price was not disclosed, and in this industry it never is. Luke Plumpton, a partner at O2, said on the record that day that his firm was extremely pleased at the progress since it invested in 2018. The following year, EIS ranked second on that list at $172.8 million. It needs no sponsor either. Arctic Slope Regional Corporation assembled one the same way, taking National Environmental Group and Niles Construction Services of Flint, Michigan in July 2017, and by 2022 its ASRC Industrial sat at the top of that ranking, up 22% in a year. Which raises the obvious objection, and it is the right one to raise. Buying 8 companies and putting one logo on them does not make the work better. Same crews, same trucks, same $10 suits. All true. That is precisely what makes the arithmetic work. 8 abatement contractors in 8 different counties with 8 sets of accounts. What follows is an illustrative model, and it is education and entertainment rather than financial or investment advice. Every assumption is spoken as it goes in. Each does about $2.5 million of revenue, well below the 20th ranked firm's $13.4 million, so this is the deep part of the tale. Together, $20 million. Assume each clears $325,000 of EBITDA, meaning earnings before interest, taxes, depreciation, and amortization, the line a private business is priced on. That is 13%. Nobody publishes an audited margin for this trade, so I picked it. If it is wrong, every dollar after it moves too. Combined, $2.6 million. Now the latter, and both rungs you actually stand on come from one dataset, measured the same way in the same 6 months. GF data collects completed private company transactions. In the first half of 2025, businesses changing hands at a total value between $1 and $5 million went for an average of about 5.5 times trailing earnings. That average covers all industries, not abatement specifically, because no abatement acquisition has ever had its price disclosed. 8 of those earnings pools at that multiple is 8 deals of just under $1.8 million apiece, each one inside the band whose multiple that is. Total outlay, $14.3 million. Now stand back. One company, $20 million of revenue, $2.6 million of earnings, and worth, as a whole, somewhere in the middle teens of millions. On GF Data's own ladder that has stopped being a $1 to $5 million business, it is a $10 to $25 million one, and the same report prices that rung at 6.2 to 6.7 times. So take the same $2.6 million of earnings. Do not improve it. Do not change one crew, one truck, one contract, or one price. At 6.2 times, it is worth $16.1 million. At 6.7, $17.4. Against $14.3 million paid, that is $1.8 to $3.1 million created on earnings that never moved, roughly $230,000 to $390,000 for every company bought. Smaller than roll-up arithmetic usually advertises, and honest. GF data calls the gap between those rungs nearly a full turn, and a turn just means one more multiple of annual earnings. 7/10 to 1 1/5 is what aggregation alone pays, and it is what aggregation pays in any fragmented trade whose size rungs are priced this way. None of it needed a synergy, which matters because a merger saving is the easiest number in this arithmetic to assert and the hardest to evidence. Still inside the illustrative model, move the one number I picked. Say each firm clears 8%, not 13. 8 is picked the same way 13 was. Each clears $200,000, the pool is $1.6 million, and 8 tickets at the same multiple cost $8.8 million. Now re-rate it the same way, and the latter stops cooperating. $10 to $25 million was the rung this exercise was built to reach, and that pool priced across that rung's own range lands the combined company at $9.9 to $10.7 million. The bottom of the range puts it under the band's own floor. The top of the range clears that floor, and only just. A re-rating that survives at one end of its own range and not the other is not one you can bank, so price the pool where it plainly still sits, at the multiple it was bought at, and it is worth $8.8 million. Exactly what was paid. At 13%, the step is real. At 8%, it disappears, and the only thing that moved was the margin. Now the rung above, where the big numbers everybody quotes actually live, and the company we just built is nowhere near it. In May 2025, Acuren agreed to buy NV5 for approximately $1.7 billion, which the announcement put at about 10.3 times that year's expected adjusted earnings. That is a real number standing on a different ladder, so price the ticket instead. Back the earnings out of that deal. $1.7 billion at 10.3 times implies about $165 million of them, 63 times what our 8 companies threw off, and within touching distance of the entire annual revenue of the largest abatement contractor in America. NV5 works out of more than 100 offices. Both parties are publicly listed, so every quarter of those earnings is audited and filed. The announcement calls the revenue recurring, anti-cyclical, and compliance mandated, which at that scale it is, and the cash half of the price came from a committed $850 million term loan. That is a sentence no $20 million company gets written, and the 10.3 is struck on a forecast year rather than a finished one, which flatters it. So every rung has a price. 8 signatures and $14.3 million by the step from 5.5 to 6.5. The 10 times rung needs 63 times the earnings, a public listing, and 100 offices. And here is what the first climb buys. Go back to the form. Those 7/10 of a turn are a balance sheet large enough for a surety to write a bonding capacity that admits you to hospital and university and utility work, 3 clean years of injury records, and a place on enough annually re-earned lists that the phone rings. A $2.5 million contractor cannot accumulate that fast enough to compete. The combined company inherits it the day the papers are signed, because a bonding line is written off a balance sheet, and there is now one balance sheet where there were 8. When One Priority and Earth Services merged, 2 companies, their announcement put the combined bonding capacity in writing on day 1, $60 million. Question 8 asks a bidder what it owns and what it rents, and the honest thing about that question is that the answer decides nothing. It cannot. Every item on the list has a daily rate beside it. The question that decides sits 22 items further down, and what it wants is a letter written by a surety agent about a set of accounts that closed last year. That is the gate on this industry, and it is worth being exact about what kind. It bars nobody from the trade. $250,000 still starts a company tomorrow. It only decides who may quote the large jobs, and therefore who ends up owning whom. Every price in this trade splits 2 ways, and the split that matters is not cheap against expensive. There are 2 columns here, one quoted in dollars and one quoted in years. Machines, trailers, vacuums, and suits are the first column, and you can clear it this week. Bonding capacity, an experience modification rate, and a place on a list that expires every December are the second, and nothing in it clears early. That second column is where the scarce thing lives here, because permission accrues on a calendar nobody in this trade controls, which is why a buyer will pay most of a turn of profit to skip 3 years of it, and why the rung above that needs 63 times the earnings. That is the strange part about $250,000. It is real money, it is enough, and it still gets you in. What it will not buy you is a single one of the years the form asks for. Those arrive 1 September at a time, at the same speed for everyone, which is why the quickest way to own 3 of them is to buy a company that already spent them.